An IRS audit takes place when the Internal Revenue Service chooses to review a taxpayer's accounts to verify that tax laws are being followed. That said, your chances of being audited escalate depending on various factors, including the types of deductions or other tax breaks you claim, the business you're engaged in, and your income level. But filing your return completely, accurately, and honestly can reduce your chances of unwanted attention from the IRS. Here are 10 potential audit triggers. Health insurance. Health and long-term care insurance for your employees, their spouses, and dependents are 100% deductible as a business expense. Employers can also reimburse employees for actual medical expenses for the employees and employees' families, such as doctor bills, hospitals, prescriptions, lab tests, and many other medical expenses. The employer gets a full deduction, and the payments are not taxable to the employees. Be careful, however, not to reimburse employees for the cost of health insurance they themselves purchase. The reimbursement may be considered taxable wages. In addition to the deductions, employers with 25 or few full-time workers may also be eligible for a small business healthcare tax credit. If your spouse is an employee of your business on the payroll with regular employee payroll deductions, your spouse and family, for example, you and your children, are eligible for full employee health benefits, both health insurance and actual medical expenses, and the cost is fully deductible as a business expense. You come under the 100% deductible employee health insurance rules, not the self-employed insurance rules, which is a big tax savings. To get this deduction, all your employees, if you have other employees, must be covered. Here's the IRS red flag. Putting your spouses on the payroll and deducting your entire family's health insurance is a loophole in the tax law that the IRS is often suspicious of. The IRS has often challenged the deduction on the grounds that the spouse is not really an employee or is only doing minimal work and is only on the payroll to get the health coverage. The IRS considers the cost of the health benefits to be unreasonable compensation, that is, more money than is reasonable for the amount and type of work your spouse is doing. Tool allowances and reimbursements. Payments to employees for use of their tools or equipment are considered taxable wages unless the payments are part of a formal accountable reimbursement plan, which is a written policy that the expenses are business-related and that they are substantiated, which means you have receipts. IRS red flag. Tool allowances and similar arrangements that attempt to avoid paying wages and to avoid payroll taxes invite audits. Even with an accountable reimbursement plan, the IRS is likely to challenge the deduction. Repairs. Minor repairs to buildings, machinery, and equipment are deductible as a current expense. Generally, the IRS considers any repair that costs $2,500 or less to be minor and deductible. For repairs to buildings, the maximum increases to $10,000 for buildings that cost $1 million or less. These deduction limits are actually rules that apply to building improvements, but it appears the rules also apply to repairs. Major repairs are deductible if they do not add to the value or prolong the useful life of an asset. Such repairs are depreciated over a period of years. Whether a repair adds to the value or prolongs the useful life of an asset can be conflicting. IRS red flag. Businesses deducting expenses, repairs in the thousands of dollars, have often been challenged by the IRS. Gambling expenses. Generally, gambling expenses are not deductible as business expenses. Professional gamblers who are in the business of gambling can deduct gambling expenses as business deductions just like any other business, as long as the gambling is legal in your state. Business deductions are not allowed for illegal activities. IRS red flag. Claiming a deduction for gambling is inviting an audit. The IRS is very suspicious, often correctly, that gambling is really a hobby, not a business, and may also be an illegal activity. Bitcoins. Business expenses paid in Bitcoins and other cryptocurrencies, which is digital currencies, are deductible as barter transactions. The amount of the expense is the fair market value of the goods or services you are getting in exchange for the Bitcoins. IRS red flag. The U.S. Department of Justice thinks that anyone using Bitcoins is likely to be involved in illegal activities or tax fraud, and it has instructed IRS agents to be looking for Bitcoin activity. Aircraft. Business aircraft can be deducted the year of purchase or depreciated over 5 years. If the aircraft is used partly for non-business purposes, the costs are prorated between business and personal use. The cost to rent, lease, or charter an aircraft for business can be deducted. If any of your employees, including the owners of corporations, use the business aircraft for personal trips, the value of the flight is considered taxable wages subject to all payroll taxes. IRS red flag. Unless you're in the airplane business, such as flying, leasing, selling, a business deduction for owning or using aircraft could increase your likelihood of an audit. If you're audited, the IRS will ask to see detailed records of the aircraft's use, looking for invalid deductions that were in fact personal, non-business expenses. Athletic facilities. Athletic and recreation facilities on the business premises are deductible if they are open to all employees. Dues and membership fees to athletic clubs are not deductible. IRS red flag. Unless you have a lot of employees and a big operation, any deduction for athletic facilities or equipment will invite an audit. Trailers. Travel trailers, utility trailers, and movable mobile homes can be deducted the year of purchase or depreciated over 5 years. Permanent mobile homes are usually considered real property and are depreciated. IRS red flag. If you're staying in a trailer while traveling, your travel and living expenses are deductible, with the cost of meals 50% deductible. If, however, you're constantly traveling, living in your trailer, the IRS considers the trailer to be your home and will disallow travel expenses. Startup costs. Business expenses incurred before you start operating your business come under different tax rules than expenses incurred once you are officially open for business. The IRS has 2 categories of costs associated with starting a business: startup cost and organizational costs. Organizational costs apply only to businesses being set up as corporations and are limited to legal and accounting services and government filing fees to set up the business. All other costs of starting a new business, that is before you actually open the business, come under the startup cost rules. Up to $5,000 of startup cost can be deducted the first year the business opens, including costs incurred in previous years before the business was actually operating. The total deduction for startup costs, current and previous years combined, is $5,000. Expenses in excess of the $5,000 maximum are amortized over 15 years. The $5,000 deduction phases out dollar for dollar if startup costs exceed $50,000. You get the deduction the year you start the business, not the year you spend the money. If you do incur startup expenses but never actually start a business, the expenses may be deductible as a capital loss under the IRS's capital gains and loss rules. IRS red flag. The IRS has often argued with taxpayers over which costs are and aren't startup and at what point a new venture is actually in business. The IRS says that startup costs are those that are incurred before opening day or before business begins. I suggest you put off as many expenses as possible until the business is operating. Prepayments. Prepaid expenses that do not extend beyond 12 months can be deducted when paid, even though the expenses may be for part or all of next year. For example, you could pay for an insurance policy this year that ran from December of this year to December of next year and deduct the entire amount this year. Another example, you could pay for a policy this year that covered January through December of next year and get the full deduction this year, even though the entire period covered is next year because the coverage is for no more than 12 months. Prepaid expenses that cover more than 12 months and prepaid expenses that extend beyond December 31st of next year, 2020, not this year, 2019, cannot be deducted until the year the expenses apply to. Only the current year's portion can be written off this year. IRS red flag. The IRS says that prepaid interest, rent, leases, and prepaid taxes are not deductible until the year they apply to. Some tax courts disagree and have applied the 12-month rule to these expenses. Unless there's a significant tax savings for you, I suggest staying with the IRS rules on prepayments. You'll get the deduction next year and not risk an IRS audit. Understanding the red flags that can trigger an IRS audit is a good way to help you verify that your tax return deductions and claims are accurate and well documented. Well, I hope you enjoyed my video, and if you haven't done already, please subscribe and give it a thumbs up.